there is still a risk that they shut down all CapEx into commercial real estate, that there ends up being a trickle-down impact. We're not getting a lot of new supply coming to market in residential real estate. But again, the fact that unemployment has stayed this low, despite the Fed's best efforts to try to create unemployment, irrationally so, I might add, I think that the soft landing camp is much more likely at this point than a hard landing, yes.
The big market news this week is that U.S. Treasury yields hit a 16-year high. We're going to examine why bond yields have spiked, the economic growth expectations that this move signals, and the implications for equities in today's video. According to the Financial Times, the yield on the 10-year note rose as much as 0.1 percentage points to 4.35%, surpassing a previous high in October and sending it to the highest level since November 2007. The yield was still close to that level in late afternoon trading. Bond yields rise when prices fall. The article further explains that the month-long sell-off in U.S. Treasuries has been mirrored on the other side of the Atlantic, with yields on 10-year bonds in the UK and Germany recently hitting their highest levels since 2008 and 2011, respectively. Now, I picked the FT for my source of information because when it comes to economics, business, and finance reporting, they're simply one of the best. I've been personally reading the FT ever since college when I studied finance, and I continued to read the work well into my career as a macroeconomics researcher and then later as a financial journalist myself. Throughout the more than 10 years that I've read their work, they've consistently upheld a reputation for reliability, objectivity, timeliness of reporting, and thoroughness of research, often getting quotes from top-tier analysts that not all publications have access to in order to add some more color to the story and provide more insights for the readers. The FT currently has a network of over 700 journalists from all around the world, and if you click on the link down below, you can access a 1-month trial for only $1. And with that, you have access to award-winning journalism and coverage to all asset classes in all markets around the world, as well as exclusive interviews with market makers, government officials, and analysts. Links are in the description down below. And now we're going to be examining the markets, expectations for the upcoming Jackson Hole conference, and the broader macroeconomic outlook with our next guest, David Bahnsen, managing partner and CIO of the Bahnsen Group, which manages $4.5 billion in capital. David, welcome to the show. Good to see you.
Thank you so much for having me.
So let's start with the topic du jour. The headline of the day is the U.S. Treasury hitting its 16-year high. It seems to me that the market overall is a little bit more optimistic about the economy, which partly may explain why bonds have been selling off. What is your interpretation of what's going on with the bond markets right now, David?
Yeah, I think over the last 4 weeks, there's a number of things. You saw the 10-year go from 375 to closing in the 430s today. So the 10 years moved up 59 basis points, and yet inflation expectations in tip spreads have only moved 11 basis points. So almost all of that increase is in real yields, not in nominal yield, not in inflation expectation. Real yields have really picked up. So there is clearly some optimism in the bond market about non-inflationary economic growth. It is not an inflation concern. It's some economic optimism. And so I think if the stock market had been pricing in throughout much of the last 6 months, diminished expectation of a recession, then the bond market seems to be catching up to that. Some form of repricing, lower expectations of recessionary impact. You combine that, though, with a very significant increase in Treasury supply that has come to market. There was a more diminished supply being issued before the debt ceiling negotiation was reached, and there's definitely been a pretty substantial pickup in supply that's come to market via issuance. And with, of course, the ongoing quantitative tightening, which is itself a mechanism for controlling the long end of the curve. And the Fed has continued to tighten the balance sheet, and that has an impact on rates, particularly at the long end. And then Japan is the fourth factor. It's not meaningful, but when their yield curve control had been holding the 10-year between 0 and 50, and they've let that breathe a little bit, these bond yields do act very globally. They are anchored one to another. And to the extent there's been modest and marginal breadth in the 10-year yield in Japan to the upside, it's allowed some of the counterparts in Europe and the US to move higher too. So you take that in whatever order one wants, but from recessionary expectations being diminished to higher Treasury supply to Japan's anchor to quantitative tightening. That gives you four pretty good reasons the bond yields have moved higher. And of course, the question is whether or not they'll continue to do. And we're firmly in the camp that no, they will not. That there is some point when the inflation expectations are so low that a more rational growth expectation for the next 10 years comes back. And when the Fed begins cutting on the short end of the curve, whether that's in 2 months or 12 months, at some point when the Fed funds rate comes lower, we have no question about the fact that growth expectations, nominal GDP growth expectations are not robust enough to support a higher long end of the curve.
Okay, we're going to come back to economic outlook, but just a note on the S&P and what it's done so far. You mentioned that the bond market is catching up to the stock markets. Why is it that the stock markets and the 10-year have been diverging over the last 2 weeks? The 10-year and the S&P have followed a very close correlation up until 2 weeks ago. Why that divergence now?
Well, I think that the 10-year bond pricing and the S&P are highly correlated right now. That you normally expect a bit of reverse correlation. And let's say that there is, again, that's the problem with stock and bond correlations is that there's four variables in the quadrant. There's high growth, low growth, and high inflation, low inflation. And not all growth is inflationary, and not all low inflation necessarily means high growth, right? And so I think that getting alignment around what to expect has taken a bit of time. Now, I think that right now, the notion of a 20 times PE in the S&P is just as ridiculous as a 5% bond yield would be. And so it seems to me that that risk asset on the equity side is ahead of itself, largely driven by some of the overvaluation in technology.
Do you think tech stocks will suffer as a result of higher rates? Just reading this headline again. Technology stocks suffer as real yields hit 14-year high. Rates make sector less attractive and weigh on indebted companies. Do you agree with that statement?
Yeah, I think that tech stocks are very much ahead of themselves. And whether it is downward pressure on short bonds, whether it's downward pressure on long bonds, or just simply valuation rationality, oftentimes one of those things, being the first domino to the other, there will be a normalization that unfortunately will probably hit technology the worst because of reversion to the mean in valuation.
You don't think that fundamentally, though, there's a lot of supply for the things that technology, the big tech companies are supplying right now, subscription services, chips, whatever the case may be?
Oh, I do. I just don't think it's worth 200 times earnings.
Okay, fair enough. Would you go as far as to say that this is 2001?
You mean 2000?
Yeah.
Yeah, I would. I don't know that the overall NASDAQ. I mean, look, the NASDAQ was down 34% last year. So you took a lot of froth out of that market last year, and the NASDAQ is still down 8% from where it was 2 years ago. The S&P is only flat from where it was 2 years ago. And so even with the market's move here this year, there's still a lot of running in place. And the sell-off didn't begin until 6 months after that, right? You had the end of 21 and beginning of 22, things were still moving higher. So this kind of running in place market is what I tend to expect will be the case for quite some time. But that divergence between the S&P and NASDAQ versus the Dow is an ahistorical event. And the last time it happened this profoundly was 2000, where the NASDAQ dropped 70%, the S&P went into full bear market, and the Dow was up double digits on the year. We are not used to thinking that way in what has been a post-GFC risk on, risk off market. Since the financial crisis, we're just used to two speeds. Risk is on or risk is off. But high dispersion of results within market indices, that has happened before. And I think it's what we're going to be seeing for for at least a couple of years to come.
Okay, let's talk about your economic outlook. Several big Wall Street firms, including the Bank of America, recently shifted their stance from a hard landing to a soft landing outlook for the end of the year, in light of incoming economic data that may signal more strength than previously anticipated. Have you managed to shift or change your outlook at all this year in light of new data? Have you shifted your allocation, for example, in your funds?
Well, we manage custom portfolios individually, and we have not remotely shifted our allocation. Our viewpoint right now on the macroeconomics you're asking about is identical to what was at the beginning of the year, which is that the Fed seemed set to tighten to the point of breaking something, and yet the damage seemed to be reasonably contained to certain sectors of the market. And that a lot of the unemployment we've seen, not a lot, all of the unemployment move we've seen was in technology. You had Amazon, Microsoft, companies like that laying off 10,000 people, and yet you saw the overall BLS number staying at 3.5%, 3.6%. That was very much like the post-2000 recession, 2002, where technically we did have a recession, but most of the country didn't know we were in one. It was really quite isolated in Silicon Valley. And my own view macroeconomically is that the Fed is highly unlikely to be able to get away with staying higher for longer. Now, look, I am utterly shocked that they got the Fed funds rate to 5.25%, 5.5%, and haven't broken more. And if they start to wave the white flag going into the election year, which I don't think is all that unlikely, candidly, if the worst damage that comes of it was Silicon Valley Bank, First Republic Bank, that will be a real miracle, and that is entirely possible. So there is still a risk that they shut down all CapEx into commercial real estate, that there ends up being a trickle-down impact. We're not getting a lot of new supply coming to market in residential real estate. But again, the fact that unemployment has stayed this low, despite the Fed's best efforts to try to create unemployment, irrationally so, I might add, I think that the soft landing camp is much more likely at this point than a hard landing, yes.
Okay. Now, just on the note of the Fed, you mentioned that you were surprised that the rates got up as far as they did. I have heard that argument before. All throughout last year, people were telling me that it's unlikely that things would go up or the Fed funds rate would go up this high for the exact reasons you mentioned. But my question and the counter argument to that is, why would things need to break? If you think about where the Fed funds rate was historically, it's been higher than 5.5% on many occasions. Mortgage rates, I view, have been higher on many occasions. So what would have to break to make sense?
Yeah, it just isn't true. The fact of the matter is that you're talking about 15 years where the Fed funds rate was essentially at 0%, with about 5 minutes in that 15 years where it got up to 2% in the end of 2018. So regardless of where it may have been in 1978 and 1981, this society and this level of borrowers, whether it be governments, corporations, or households, this level of borrowers is highly accustomed to a level of borrowing, a cost of capital that is significantly less, to a point where debt service as a percentage of EBITDA in corporate America was substantially lower, where debt service at a household since the deleveraging of post-2008 was substantially lower. And so that higher cost of capital is not normalizing, because there is a natural rate in the universe at which the rate is neither expanding nor contracting economic activity. Well, what is this level of rate doing? There is no new issuance in levered loans. There is no new issuance in commercial mortgage borrowing. There is very little new issuance in residential borrowing. So they've obviously tightened credit substantially. It's just that tightened credit has not led to a malignant economic outcome yet. And that, to me, is a miracle. And I don't know why the Fed wants to tempt fate to go create that negative outlook. Now, the reason is that philosophically, they believe that an antidote to inflation is people losing their jobs. I just totally disagree. I think the Phillips curve is entirely misguided, but that's the philosophical modus operandi they're working with.
Why is it then you think that nominal growth over the long term would be low, even despite the Fed funds rate coming back down?
because the Fed funds rate coming back down reflects lower nominal growth. It doesn't create lower or higher nominal growth. It is a price signal. It is not a price creator. And the reason I believe nominal growth will be lower is because debt to GDP is higher. And so fundamentally, we have a crowding out of the private sector, which is where more productive growth investment takes place. And so it's the dynamic I refer to as Japanification, that essentially higher debt to GDP has a diminishing return. You get a lower marginal revenue product on your debt, and that puts downward pressure on the ability to productively allocate. Then, as you point out, the Fed funds rate comes lower, and that disincentivizes productive investment and leads to people leveraging up non-productive investment. And it also keeps zombie companies alive longer because they can continue to roll their debt at a lower cost, as opposed to those companies going away and new companies replacing them that are more productive. And so in a lot of ways, the problems I anticipate that we will face are caused by the things policymakers do to solve the problems they're worried about. That's the paradox of Japanification.
You don't think that we may fall into a Japan trap where deflation sets in and the S&P or the NASDAQ don't rally to its previous all-time highs for another 20 years? Is that possible?
Well, look, there's two different things you just asked, and they're not the same. I think that Japanification is very likely to happen, and that's what we've been living in for 15 years, and the S&P did make new highs. So you could definitely see our S&P grow even when our economy is only growing 1 to 2%. Now, that isn't outright deflation with the same demographic significance Japan saw, but they basically had 0% real economic growth for 30 years, and we've had 1.6, but we averaged over 3.1 for 70 years. So we've been living off half of our real GDP growth, and yet the S&P was quadrupled over a 15-year period. So you can get better corporate profits without the nominal GDP growth we're used to. We went 15 years with 3.6% nominal GDP growth. But in the 20, 30 years before that, we were used to getting 5, 6, 7% nominal GDP growth. So I think those are two different issues. What happens with risk assets is a byproduct of valuation, of multiples, of cost of capital, of scarcity. You know, if you have low GDP growth, then, and you're not going to get a competitor to Apple or Amazon or Tesla or the hot dot companies, then I guess it boosts the valuation of the last hot dot companies, right? But if you get better GDP growth, you may have more competition, more vibrancy, more vitality in your economy, and yet potentially have lesser returns for some of the big tech companies. That's the real paradox of what we're facing and what we have been dealing with since the financial crisis.
But more specifically, are you concerned about consumer price deflation?
I'm not concerned about consumer price deflation yet, but I do think it is a possibility. But America does have some structural advantages over Japan. And I think China's facing consumer price deflation now, and America is doing plenty of things to make it a problem. I mean, our demographics are not as negative as Japan's, but they're much more negative than we're accustomed to. And so whether it's demography, population growth, either by immigration or fertility, and then just the overall productivity of our the greater output in the economy, those things I do believe have all stagnated. And even though it hasn't led to outright consumer price deflation or asset price deflation or a debt deflation super cycle, kind of what Irving Fisher so famously warned about since 2008, I believe that it is always a possibility that low, slow, and no growth can lead to deflation.
What do you think will likely happen first next? A collapse in the stock market or a recession?
A recession is more likely than a collapse in the stock market.
All right. Well, in light of what we discussed, factoring in everything that we've talked about so far, Jerome Powell's probably looking at similar data. What do you think he's going to do next? And maybe we can give a Jackson Hole preview. He's expected to make a speech this Friday. Any changes you think might happen?
Last year when Chairman Powell spoke at Jackson Hole, it was market impactful. It did move the markets negatively. And yet, most of the time over the last 25 years plus change, Jackson Hole speeches have been widely overrated. There have been a couple that move the market, some way up, a couple way down. Last year was one of them. For the most part, it's usually nothing new, nothing that markets hadn't already priced in. I certainly don't expect Chairman Powell to say anytime soon what he did in early 2019, which in early 19, I believe it was January 3rd, after several quarters of hawkishness in 2018, quantitative tightening and a 225 basis point move higher in the Fed funds rate. Powell in early 19 just came out and flat out said, we waved the white towel, we surrender, we're done, we chickened out, we're not going forward. He's not going to do that anytime soon. But do I think he'll signal to markets that they see a light at the end of the tunnel, and that the where they believe the shelter inflation number is going and what it will do to the overall inflation rate gives them optimism that they can sit still for a while and allow these numbers to bake in, allow the rest of us market watchers to price in what the lag effect is on what they've already done, and not have to continue moving higher. I think Powell will signal that, and I certainly think that's what they will end up doing. I will be surprised if they hike another quarter point at all, and I will be surprised if they're not cutting rates by this time next year. And at a total desire to avoid any sort of cynicism or conspiratorial thinking, but just talking like an adult who has studied history, I don't think it's highly likely that they go into an election year tightening further. It's just not very common. And in 2016, you had a great precedent. They went in at the end of 2015, they got off the zero bound by 1 quarter point rate hike and said, we're going to be raising rates 4 or 5 times next year. And they didn't raise at all. They just let it stay flat throughout the whole year. And it is very hard for me to believe that the Biden administration has chosen a campaign theme of Bidenomics if they didn't believe that the Fed was set to soon be more accommodative. So people can interpret that however they want, but it just seems to me to be a not unreasonable speculation based on the lessons of history.
Right. Final question on the markets. And I want to move on to talk a little bit about your book that's coming out soon. Now, David, you mentioned that we are in a pre-election year. Historically, pre-election years have been good for the markets. Are you expecting this trend to continue then throughout the remaining of 2023?
Well, let's see. As we're talking, the S&P is up 13.5, the Dow's up 3.5, and we have 4 months to go, and I don't expect any major negative surprises. Now, look, don't expect a surprise is sort of a tautology. By definition, surprises are not expected, right? So there's geopolitical events that could happen. There's any number of issues there. But look, I think the corporate earnings dropping in late 22, that number was supposed to be a lot worse than it was. Earnings were supposed to go lower, and earnings expectations were supposed to go lower. The biggest problem I see for markets right now is just valuation. If the S&P was trading at 16 times and you had earnings where they are, and the Fed where it is, and the economy where it is, I'd be much more index bullish. But I think the one problem that S&P holders have is just simply the 20 times multiple. That's still not a very good timing vehicle, but generally speaking, when you enter at that level of price, your returns are going to be more muted. We're more individual stock pickers. We run more concentrated, high conviction portfolios, and we're more valuation conscious. So we're a little less worried about it. Our blended PE across our portfolio is closer to 15 times, not 20 times. But I think that, very likely the indexes will end this year positive based on where things are now. It's not a super bold prediction when you have 4 months to go and you're up 13.5%.
So which sectors do you think are less overvalued? I don't want to use the word undervalued if that's not something you believe in, but less overvalued.
Oh, well, some are undervalued. I mean, I think real estate with some of the publicly traded REITs, utilities, certainly some of the financials, and even some energy companies continue. Now, energy's had quite a little run here the last few months, And as we're talking right now, 90% of the holdings in the energy sector are now over their 200-day moving average. So you've seen a lot of correction, beneficial correction to the upside in energy. But I think that you have healthcare, utilities, REITs, and energy that no one could reasonably call overvalued. But as far as where I think that there is overvaluation, it's primarily technology, communication services, and consumer discretionary. One of our favorite sectors is consumer staples, which has been a laggard, yet we've just had good luck with some of the names we own. But I wouldn't call the whole sector undervalued. It's a little less overvalued, as you put it, than consumer discretionary. But some of those valuations are still pretty rich.
Excellent. Well, I appreciate your thoughts on the markets. You're an author of a number of books that have already been published, including your last title, There's No Free Lunch, 250 Economic Truths. Your newest book that's coming out is called Full-Time Work and the Meaning of Life. You know, we all strive to find the meaning of life. David, have you found it? Is that why you're writing this book?
Yes, I think so. And I think that we're doing some interesting thing as a society. Economically, I mentioned that we're struggling with this stagnation. We're not seeing a lot of productivity boost. We're not seeing a lot of GDP growth. And 82% of men either have a job or are looking for a job. Even with only 3.5% unemployment, we have the same percentage of men looking for prime working age, that is, looking for a job or have a job. That's the same number we had in the Great Depression. So there's a cultural dynamic in which work, rather than being seen as a solution economically, spiritually, existentially, ontologically, rather than seeing work as a solution, we're seeing work as part of the problem. And I think that needs to change. I think that we're due for a cultural transformation around the benefits of work. And so the website of the new book is fulltimebook.com. And I make the argument for work as effectively the meaning of life, what we were created to do here on Earth. And it's a controversial book. I don't crave controversy for controversy's sake. But I do think this book is sure to make me a few enemies, and I'm okay with that.
David, I appreciate your candor. We'll put the link to the book in the website. Now, without spoiling the book too much, maybe just give us one or two pieces of advice for people who want to find a career that is satisfying and productive and also fulfilling for them, for their lives. How do you go about doing that?
Well, I think if you mentioned my last book, There's No Free Lunch, 250 Economic Truths, one of the reasons why I'm so devoted to the freedom cause and to the notion of free enterprise is the way in which it does facilitate human flourishing. I think the miracle of markets, which is very understated, is that it facilitates exactly what you just said: specialization, division of labor, mutual cooperation. These are dynamics that spontaneously create a certain social organization that allows people to find meaning in their lives, including vocationally, that we do not have to go work on the family farm. We do not have to follow our dad into a tedious factory job. Now, there's a lot of meaning in a farm job, a factory job. But if somebody wants to marry their passions to their skills, in a market economy, they have the ability to do that. And policymakers should not be getting in the way of that. But on a personal level, I believe that's really the opportunity we have in front of us, is to see vocational work as where we can marry our passions to our skills, to quote Arthur Brooks. The issue we're dealing with right now is not that there is not enough opportunity for workers to marry passions to skills. The problem we're dealing with is we have a lot of people that no longer want to work or view work in that sense. That there has been a decision made in which work is drudgery, as opposed to productive use of our faculties where we can be fulfilled by serving mankind. What do you mean serving mankind? Nobody gets a paycheck without producing goods and services that meet the needs of humanity. It's the only thing anyone's ever going to pay you for, is providing benefit to others. And to do so in a market context where you can build up marketable skill and activity and so forth is, to me, an extremely exciting part about being an adult.
So ask what you can do for your society, not what your society can do for you.
The beauty is that those two things go hand in hand. What you can do for your society is what will then turn around and pay you and compensate you and so forth. And so there is, one does not have to choose. That there is a mutual reinforcement in a market economy that allows both this is kind of classical economics 101, that Adam Smith, operating out of my own self-interest, by optimally serving my neighbor, I can grow my own career, my own comforts and quality of life, serve and benefit my family, and do so by producing incredible social good.
David, fascinating talk. Thank you very much. Where can we learn more about your work, read your thoughts, follow your funds?
Yeah, so the weekly investment writing is available for free at dividendcafe.com. Dividendcafe.com is where I write weekly investment commentary. And at Bahnsen.com, or just my last name, BAHNSEN.com, that's where you could find really my whole life turned upside down, my economic writing, political writing, all my podcasts, more personal information, books, all that type of stuff, including a free economics course that I created there. Nothing for sale, just available as a service to people at Bahnsen.com.
Excellent. Well, thank you very much for providing the service. We'll put the links down in the description below, so make sure to follow David at those links. Thank you very much for your time today, David.
Well, my pleasure. Thank you so much.
And thank you for watching. Don't forget to subscribe.